Hello, everybody, and welcome to another episode of the Cross Country Super Podcast. And as usual, I'm joined by Jemma Sanderson over in beautiful Western Australia, Perth. How you going, Jemma?
I'm pretty good, Darin. Survived 30 June. So, that's always a good outcome, I think.
That's great. That's great news that you're still alive and kicking and you have survived that bit of a stressful period for practitioners, obviously.
Yes, it is indeed. Trying to get all the ducks lined up.
And as usual, this podcast is brought to you by SMSF Property Valuations. Need a current or retrospective SMSF property valuation? Whether it's for annual financial statements, pension commencement, or related party transactions, SMSF property valuations offer fast, reliable, and audit-ready reports across Australia. And I know I keep banging on about this, but you know, with all of the change happening, not just what we're about to talk about, but with all of the change happening in the superannuation world and more specifically the SMSF world, valuations are going to be absolutely top of mind and
Yep,
something that can't
100%.
be ignored in the immediate future and the future that I can see extending, you know, into the next few years at least.
100%. This is going to be a really full-on year, I think. The 26, 27 year in, valuations are going to form part of a lot of things, as well as just the consideration of structuring for Division 296. What might you do this year? Do you pull big amounts of money out? Obviously, if you're eligible to, do you make your cost base adjustment? Again, valuations will really guide that. And then with what we're going to talk about today, the valuation of assets in non-SMSF land in terms of the new CGT provisions that have come out in the delightful budget.
Yeah, yeah. Now, today's episode is actually a bit of a take two because we did previously record a podcast about the budget. We're going to talk about the budget today. We did previously record a podcast about that, but of course, as we well know, the budget and a lot of the horse trading that's going on to get this horrible thing passed through both houses of Parliament has become a bit of a movable feast. And one of those movements kind of destroyed a whole segment that we recorded
Yeah,
when we
sure
first
did.
did this podcast.
Mm.
So we've had to go back to the drawing board and redo it. So obviously very important because we don't want to misinform you about any of the stuff that we talk about today. So that's where we're at the moment. So we've done a bit of a rehearsal for this one, but we're going to do it again in light of some of the new developments that have happened just in the last couple of weeks.
Yep, exactly. Exactly. So, and once
So,
again, another exciting topic for us to have a chat about, Darren.
absolutely. Now, I thought we'd get started on a very positive note, Gemma, and it has been pretty widely recognised that the budget did actually enhance the superannuation sphere as the best tax effective savings environment that individuals can really choose right now. I
Oh,
mean, it's
100%.
really,
Yeah.
it's really, it's really put a gap between anything else. It's almost like daylight second now, isn't it, Gemma?
Well, that was the thing. Like in the lead up to budget, we were all not reeling, but except I was in acceptance mode. I'm sure other people were in different modes about Division 296. And
Yeah.
we still hadn't had regulations finalised at the time about how that would be treated on death, those sorts of things. So had been chatting to clients about, look, do you pull money out of your super because your effective tax rate is starting to notch up to your 30%? And we're talking to people here that have substantial amounts in super. And then, of course, the budget came along and really stomped on that substantially. So, stomped on us strategies to maybe pull money out because super now with the change in the capital gains tax provisions that were announced and have now passed through Parliament, and the way that the treatment of trusts, super is like, oh wow, let's keep as much money as possible in super. Um, that's a generalist comment, but yeah, for a lot of people, they were thinking about pulling big chunks out, but now we might be revisiting that. That's why this year is going to be quite a busy year.
Yeah, absolutely. And obviously there's always exceptions to the rule, and you can't factor in necessarily, individual sentiment as far as that goes, and what they'd like to do. But it's almost become a bit of a no-brainer now, hasn't it, Gemma?
Yep. So yeah, for those people who are going to be impacted by Division 296, keeping their money in there is certainly worthwhile. And I do get asked, what's the sweet spot? What's the level of money that I should have in super? And previously we were looking at, do we benchmark that to say a 30% effective tax rate, etc. But they're people that have got the level of assets above that sort of 20, 25 million, where that tax rate was getting above the corporate rate. There's not that many people out there in that scenario. So yeah, by and large, unless there's other reasons why, in terms of estate planning and the like, keeping the money in super is certainly a good outcome.
So you mentioned at the top, the changes to CGT is probably one, if not the biggest driver of why we think superannuation has just got a huge leg up as far as that goes. So what are the changes to the CGT and CGT provisions, and why does that make a huge difference for superannuation, Gemma? This is more
Yeah.
technical stuff.
So the announcement in the budget was that they would remove the 50% capital gains tax discount, and that would be from 1 July 2027. So, and that would also apply to, they'd also remove the pre-CGT status of assets as well. So basically, from 1 July 27, we're going to have everyone subject to the indexation provisions from that time. So that really turned a lot on its head, especially for those people that have pre-CGT assets, because they've owned them since before 1985, and often they've gone up in value substantially, which is fantastic. And they might have held on to them for a long time because they were pre-CGT. But under these, so if they sell it before 30 June 27, then that's fine. It's still all pre-CGT. But if they decide to hang on to that asset after that time, they're going to have indexation based on the value of that asset at 30 June 2027. So sort of they're quarantining their gains up to that point, and above that, they're going to have an indexation consideration. And it's the same thing that will apply to the 50% discount. So the 50% discount will still apply up to 30 June 2027 if an asset has been owned prior to then, and then it will be subject to indexation after that. And the way that that mechanism is going to work is effectively a deemed disposal and reacquisition of the asset on the 30th of June 27.
Right.
So again, the importance of valuations and things like that. So that's one element of it. So that's enough to really create a lot of complexity in the rules. And also because you've got the main residence exemption isn't being impacted. The
Yet.
small business, yeah, yet the small business concessions are marginally impacted because you've got usually the 50% CGT discount is applied to a small business capital gain that is realised, but there's still the 50% small business. So often, if you had $1 million gain and you were eligible for the small business concessions, you could apply a 50% general discount and then the 50% small business discount. The general discount will now no longer apply, but there will be an indexation method applied there. But you are still eligible for the 50% small business discount. And one of the changes that recently came out, because the small business CGT provisions have, and now I'm just going all over the place now, Darin, so apologies. The small business CGT provisions have got thresholds that haven't been indexed since 2007. And so that's the 2 million aggregate turnover test and the 6 million net asset value test. So part of these changes coming through is that the $2 million test is actually going to be increased to $10 million. Now, they haven't changed the maximum net asset value test, which is quite disappointing, on the basis that it is the $2 million test or the net aggregate turnover test that is the one that's more often applied to those. So, anyway, so that means you'll still get your 50% small business discount if that applies. So, yeah, there's those sorts of elements coming through. And then they've introduced a 30% capital gains tax floor. So a minimum tax
It's a
on a
minimum,
realized,
yes.
yeah,
Yeah.
a minimum tax on a realized capital gain. And originally, that was unable to be reduced. So if you made a $1 million capital gain indexed, I'm using some simple figures here, then you would pay a minimum of 30% tax on that $1 million gain. Let's say after the indexation and all the other things were applied to that, it was $1 million. You'd be paying $300,000 in tax. Now, let's say you were able to make a deductible super contribution and you had unused carry forward caps. If you did that, that wouldn't reduce your 30% tax. So that's disappointing, and that hasn't changed. But originally, what also wouldn't reduce your 30% minimum tax was if you had made a donation to charity. That has changed. So if you had a $1 million gain and you put $500,000, donated that to charity, or that was a catalyst to set up your own private ancillary fund, then that 500, if it was 500,000, that would reduce down that the tax on that capital gain. So that's very succinctly and with lots of little nuance when you actually dive deep into the provisions about how those CGT rules are going to work. And then there's been some other horse wrangling, I guess you could call it, for some areas that are not part of those rules, but to get it over the line, there's been some negotiations that are adjacent to that that does flow through and impact other areas as well.
Yeah, right. To unpack some of those points a little bit more, I
Yeah,
suppose starting sort of in chronological order that you just spoke about, I
yeah,
suppose the small business concessions probably, even though they've been watered down a little bit, still present an advantageous position for a lot of small business owners who like to sell their business and then use the capital gain because they don't make regular super contributions.
yeah,
To use that as their superannuation and put it into an SMSF. So there's still a bit of advantage for that, which is yeah, at the start we said there was a big tick for super funds. That is
yeah.
still
Big tick for super.
yeah,
Another
a,
big
a
tick.
big
Yeah,
one. However, and I'm not sure a lot of people actually understand how this minimum 30% tax works. And you raise a really good point around the contribution strategy that I think was quite common, where
yeah,
people would actually make a personal deductible super
yeah,
contribution in order to reduce the capital gain
yeah,
um, that they made on a particular asset. Well, they can't do that now. They can't do that because obviously, even if you get it under the 30%, which was effectively what that strategy is trying to do, is get it under that 30% that you're going to be charged.
yeah. As a
Yeah,
marginal rate. Yeah,
yeah, you get a top up for the difference to get it back up to
that's
the
right.
30%. So yeah, I won't say there's completely no point in doing it because obviously um, individual tax rates have to come into consideration here. But in the main, um, yeah, that's really marginalized that strategy, I think.
Well, it has, but and the thing with that is it going to be that people are like, okay, well, I can't make a contribution to super to reduce down what's subject to that 30% tax. Well, maybe I will throw some more money into a charity or something like that.
Yeah,
I mean, the benefit of
yeah,
putting the money into super is that obviously it's still under your control and for your benefit in the longer term. But maybe there's some warm fuzzies that can come through there with the donations to charity coming through. And the other thing with the small business concessions is even the way that the super contributions, the CGT caps work is, I mean, that's a whole podcast in itself in terms of looking at the small business CGT concessions. So the elimination of the 50% discount, the general discount, if the normal 50% discount is available, and then there's an indexation element to there, I mean, already that is blowing my mind in terms of how that's going to interact. I've read through the legislation a number of times, and I think you've got to really just nut out every single scenario to have a look at. So there's still the $500,000 CGT cap. So if after you've applied all your discounts, you end up with, say, a $700,000 capital gain, and so you've got to be eligible for these provisions, which is a whole, consideration in itself. You could make a $500,000 contribution to super, and that would reduce down that. Say it was ultimately 700, you make your 500,000 contribution, that reduces that gain to 200,000. So, there is that element sitting in there. The other thing that came through was if you've got a 15-year exemption, because it's a small business asset, or where it was you were eligible for the 15-year exemption, but it's a pre-asset as well. You've got that higher CGT cap, which in the current year is 1.935 million. It's a substantial amount of money from the capital proceeds of the sale of a small business that can be put into super. So again, how they all interact is going to be important, and having a look at the 15-year exemption in light of that pre-CGT assets are going to be subject. So that whole thing, again, I've read through the legislation and all of the materials, but it is, and I mean, I hate saying this, the winners in all of this are the advisors to clients. It's the accountants, it's going to be the lawyers. It is complex, and there's little nuances in there along the way. The indexation of the different parts of a cost base, because you've got a property and you spend money on a renovation or all those sorts of capital expenses, those will need to be separately indexed. It's going to create a lot of work, which, as an industry, I think a lot of people will agree with me. We just don't need, because we've got enough going on
Oh,
with Division 296, anti-money laundering, all payday super, all of these other things happening.
well, you raise a really good point, and again, this is slightly going off piste as usual, as
Mm-hmm.
we like to do.
Mm-hmm.
But the government introduces all of these changes, and they're complex, and they need to be worked through properly, and they need to be calculated properly to know
Properly. Yep.
what the right strategy and the right action will be most advantageous for the individual. But on the other hand, and this isn't quite related, but it is to what you were saying, we have shrinking numbers of advisors out there
Yep.
right now. Now, at some point in time, again, I'm not sure that the government really understands the whole concept of supply and demand, with the motivation for
Let's not
making
talk
some of
about that one.
these tax changes. But at some point in time, there's going to have to be, some sort of limit to what the practitioners out there who are servicing clients can actually do. There's going to be a capacity constraint because, well, there's number one, advisors aren't octopuses, so they don't have enough arms to be able
Yep.
to deal with stuff. And number two, there's not enough hours in the day to do it either. Well,
Yep.
you guys can work 24 hours a day and still not get all of the stuff that you have to do um,
Done. Yep.
done if more and more regulation changes and legislation changes come through where, all of a sudden you've got to completely revisit all of your client situations. And of course, if you don't, you could be on the hook.
Yep.
Because if you don't do it properly, then I as a client can say, well, Gemma, actually, you should have told me about this and walked me through these scenarios. Now I've lost money, be it investment loss or tax loss. I'm going to go to you now for some compensation.
But it also could be that if it's not calculated correctly and you under pay the tax, the penalties on that are foul. And we've seen, again, digressing here, going off piste, we've seen a lot of cases recently where, again, my digression here is the family trust distributions tax is frightening. And there was articles in the press, some high profile West Australians suing their accountant because they were
Wow.
audited by the tax office and the tax officer said, you haven't done this properly. And the tax debt is massive. And
Wow.
so because it's the taxpayer's responsibility. Now they can employ their or engage a tax agent to do all of this work, but ultimately it rests with them. And then it's a professional indemnity consideration between the taxpayer and the tax agent. So that's really quite scary. And the frustration of everyone in the industry that I certainly talk to is that really the tax agents and the accountants and the tax lawyers, we're the front line for the tax office collecting their revenue, if that makes sense. So a lot of
Mm.
people do their own taxes and that's all fine. But they're probably not the ones listening into this podcast. It's going to be the advisors are listening in and maybe the trustees who are like really wanting to chat about The Simpsons and Star Wars and all those sorts of things in the context of super. Um, but
As we
we're the
always
ones
do.
who are doing the work to submit the tax returns for whatever entity it is to the tax office, get it done correctly so that the tax office can collect that revenue. So it's sort of a frontline consideration
Yeah.
there, but there's no acknowledgement of that. And it's really
Yeah.
quite frustrating because you call the tax office, there's no one that you can just call and get in front of. We used to have like client relationship managers, don't have that anymore. So you just go into the pot and someone picks you out of the mix. And so it's just adding to time. You're sitting on hold with someone in the tax office who you ultimately talk to and they don't really know what the question is. Anyway, like I said, I've digressed. So we've got this sort of stuff is going to be complex calculations that people will, in the lead up to 30 June 2027, and that'll go like that. It'll be a few months in, and then it'll be like, right, do you sell an asset? And some people that may well prompt them to do that as
Well,
opposed to hanging on to it.
especially if it's a property.
Yeah,
That's you can't click your fingers and say, "Oh, Gemma, actually,
sell
I'd
it
like to
today.
sell this.
Yeah,
Can you make sure that the funds hit my bank account in a week's time
yeah,
because I'll have disposed of that asset?" Just doesn't like clunky assets like that just doesn't work
just
like that.
doesn't
So if
work like that at all.
you're talking about a lead time, and if that's the direction you want to head in, you're gonna have to get on your skates pretty damn quickly.
Pretty quick, pretty pronto. Yep. And it's scenario analysis. It's okay, I've got my pre-CGT asset. If it goes up by this amount, should I sell it now? If it's all that sort of modeling side of things, which will need to be involved. And then of course you're predicting how the economics will work between now and 30 June 27 and then beyond that. Because if you say, right, well, let's sell it this year because I think it might go down, okay, well, you might be ahead. But then if it doesn't, anyway, so all of those, the crystal ball
Yeah.
gazing element is obviously going to be substantial and it's just going to be a lot of work. And then, this is, I don't want to call it, it's not resentful advice, but it's almost like a new tax being introduced that is going to like it's worse than the current position, people do resent the fact that they have to go out there and get advice and have it looked at properly, as opposed to back in 2007. Remember that, Darin? I do. It makes me feel old. In 2007, when all those super changes came through and like withdrawals from super became tax free if you're over 60 and all these things, that was advice that people were like, hell's yeah, sign me up, baby, sort of thing to get it to make sure they were structured properly. So different to this sort of thing now, and even transfer balance cap and Division 296. So anyway, again, we've gone off piste and I'm ranting.
Well, no,
But
that's
yeah,
all right. I'll throw another one in there. Well, two. Number one, and this is bad news for advisors, but you all know this anyway. Individuals always look to have someone to blame for their losses, right?
yep,
They'll never take it on the chin themselves. So
Yep.
that number one is you're in the firing line even more because it's not as if people will go, oh well, that's such is life. Easy come, easy go, no problem there. It'll be like, right, well, this loss isn't my
Whose fault
fault.
is it?
Surely it's
Yeah.
not my fault. I'm not
Yeah.
taking the blame for this. Somebody else has to be on the hook for this. You mentioned professional indemnity insurance. We've seen court cases where, you know, the onus has been put on the practitioner in particular. I'm talking about one audit case where the judge pretty much decided that because they had professional indemnity insurance, yeah, I'm
That's
putting
yeah.
the onus on you
Yep.
because you've got funds to cover it under your insurance protection. That's not really how
That's
the
not how
whole
it should
thing's
work either.
supposed to
Yeah.
work.
Yeah.
But if they can identify a compensation scheme potentially that's not going to come out of your own pocket, being the advisors, it ultimately does because obviously your premiums and stuff are going to
Go up.
change
Yeah.
in
But
future
they go up for
years.
everyone, not
But
just
yeah,
the
yeah.
person,
So it's not like it's without consequence, but that's obviously the thought process behind it. And I'll give you one more, you know, not that, they're not in a shambolic position right now, but Angus Taylor did say that the Liberals will scrap these taxes. So if they come into power and scrap these taxes, then we'll have another rewinding,
another. Yep.
doing of this sort of stuff. And that's in some ways therein lies some of the danger because what if you pull the trigger now?
Yep.
All of this gets scrapped, and then I'm coming back to you in a few years' time saying, well, Gemma, I didn't actually have to sell that asset.
Why did you tell me to sell that
No,
asset,
I'm
Darin?
actually a little bit
Why? Yep.
worse off
Yep.
now, and I didn't actually need to do that.
In the end, I didn't need
So,
to do it because it
yeah,
didn't. It
so
got scrapped or it
I'm a
changed at
little
the
bit
death knock.
annoyed about that,
Yeah.
maybe even angry about that. If it was, we're talking about pre-CGT assets here, so
Yep.
I
Yep.
mean, they've been held for a long time. Sometimes people can get a sentimental attachment to
Yeah.
to a particular property or something like that. And if I'm forced to sell it, then it's like, well, that broke my heart having to get rid of that. I didn't have to
I know I
do
can
it.
see that
You
too, 100%.
know?
Well, we've had a little bit of that with Division 296 because uh, February 23 is when it was announced as a new concept. Then they had draft legislation that came through, and that was at the end of 24. Then there was the election, so that draft legislation fell on the ground, but it was going to have a 1 July 25 start date. And so
Yes.
I know quite a few people who just pulled substantial amounts of money out of super because they didn't want to pay tax on their unrealized gains, which,
Yeah.
you understand. And then, a few million bucks comes out of super and then they completely flip flop and change
Yeah.
it to only on realized gains. And they were quite, as you would expect, pretty pissed off with
Yeah.
that. It's like, well, we told you not to do it and to wait, but they were concerned, quite rightly, with a 1 July start date, the draft that fell on the floor when the election was called, the government had come out and said, you've given us a mandate to put this in place. So people did
Yeah.
panic. And,
Yeah.
you
It's
know,
it's Yeah, it's certainly not something that you could criticize or unforesee because that's just human nature.
mm,
We want certainty in our lives. We don't want uncertainty. So if I can chart a path in the midst of all of this that gives me a greater deal of certainty, I'm going to potentially do it.
mm,
But then if the parameters change and it doesn't work in my favor, then I'm going to be angry that, well, why did I do that? I didn't have to
why'd I
do
do
that.
that? Yep,
And
exactly.
you know, with all of this being a movable feast, we can see that happening. Anyway, I'm going to wind it back to
Wind it
top.
back, Cop, because
Yeah,
we haven't
yeah, yeah.
spoken
I'm
about the
going to go.
things
I'm
that
going to
aren't
get back.
subject.
I'm going to
Yeah,
get
get
back
back
onto
online. Yeah,
the black runs now.
yeah,
But Gemma, could you? So the 50% discount, like that's super funds have been carved out from that, haven't they?
correct. Yep. So we
The
still
what
got our one
whatever that
third.
measure is. So how
Yep.
so how does that work?
So basically, yep, a super fund is going to be business as usual. So it's going to be if the asset is sold and it's held for longer than 12 months, you're getting a one-third discount on that gain. So that's pretty awesome. So you've got a 10% effective tax rate, as most people talk about, a CGT rate in super of 10% because it's a one-third discount. Now, for Division 296 purposes, the other thing is that that sort of one-third discount also effectively applies to that because that flows in to what the taxable income of that is with the adjustment if you've done a CGT adjustment election. But the other thing that with these CGT provisions as they've come through is the 50% discount is still going to apply for new residential dwellings. So that's again going to add to some complexity around the traps. And to get it over the line, there was a deal done whereby, and the Greens have always advocated for limited recourse borrowing arrangements in super being a rort, for want of a better phrase, and they've basically got what they wanted in that limited recourse borrowing arrangements will not be available from the 10th of August this year for any new acquisitions of residential dwellings. So we've got the consideration now that I know the SMSF Association has gone to Canberra since then, and no doubt all the other associations will be advocating for the fact that, or for the, can LRBAs be available for new residential dwellings, a
Yeah,
bit
new
like
build.
the CGT discount, and so
Yeah,
it's sort of it lines up with that, and also the complexity with SMSFs is that we've got this concept of business real property. So an asset could look like a residential premise or residential dwelling, but it's actually not. It is a business property that is wholly and exclusively used in one or more businesses under the definition in section 66(5). So we're going to have, again, just this raft of different rules applying where we're going to be, okay, can I borrow to buy a property in my super fund? Okay, well, unhelpfully, and the answer to all of those questions is always it depends. What's the
yeah,
actual property? What is the actual use of that property? All of those sorts of things. So again, that's going to give rise to a lot of people looking at that more closely. However, what is I don't like that the residential properties have been carved out of LRBAs. And, we were discussing before we started recording that a lot of residential LRBAs may actually be in the red. Because the yields on those particular properties might not be, notching up there to cover the
yeah,
wash their face, and
yeah,
so often they're funded by super contributions going in or income from other assets, etc. But it's a capital gains sort of play in there. So, but a lot of people, so the residential properties, maybe people are a bit more risk averse on investing in one of them in their SMSF. But
yeah,
certainly we see a lot of business property put in SMSFs, especially when they're being used by in the business of the members. And so
yeah. Well,
thankfully that is not caught by these new provisions.
yeah, the business real property thing, we see it every day. Probably the best examples are many doctors' practices
Yes.
around a residential home. Well, the
Yep.
structure is a residential home. They've turned it into their place of business. I mean,
Yep.
I nearly did it myself when I was looking for a business premises. We nearly rented out a terrace house in the city. So
Yeah.
effectively, that's residential, but we were
Yeah.
going to use it for business purposes, right? So it's certainly not uncommon. I know. I think
A lot of
firms,
allied
like
health providers.
yeah,
Yeah.
architect firms often do
Architects.
that. Use a residential property to house their business premises. So
Yep.
it's certainly not uncommon to have that
Almost
happen.
anyone. You could, if you're in
But
particularly some of these areas where, you've got health precincts. So it's right near a hospital. You've got your obstetrician, your GP, your physio, your chiro, your psych. They're all in old houses in the area that have just been fit out and repurposed for this reason because they're nice, lovely old houses. There's nothing wrong with them, and that's fine. Like those are business real property. The current definition would cover that. So thankfully, that's the case. So we'll just have to see how that really plays out. What I have found interesting is this concept of what is a new residential dwelling, and that new residential dwelling is one that is still eligible for the 50% discount. Also, a new residential dwelling, one of the other changes that has been announced is a removal of negative gearing, or the ability to offset the losses on negatively gearing a property against your other taxable income. So you've got to quarantine those losses, and you can only offset them against income on residential property, or if you ultimately sell the asset and there's a capital gain, you can offset those losses, but you just can't offset it against your standard taxable income. Anyway, there's a whole definition there of what a new residential dwelling is. And remembering here that the whole point of these changes to do with capital gains tax, the particularly with respect to the residential properties and all those sorts of things, is they're trying to get people into more young people into buying their first home or into the property market. And they don't really like I'll be let the slumlords out there that have got 5, 10, 15 investment properties, and they just feel that that's just greedy, and they should be, they basically, with the property prices going up, all these people can't get into the market. So they're really trying to increase supply there, or reduce demand. From that perspective. And the increase of supply is potentially people going, right, I don't want to pay tax on this, and they sell off their property. So that's the increase in supply. But really, they're trying to reduce the demand from the slumlord type people. And I apologize to everyone who's got multiple properties, but that kind of, it's an easy way to talk about it. Anyway, the comment in here is that a new residential dwelling is going to be determined by basically the minister at the time. And it makes a comment saying, before determining the requirements of whether what the requirements for a new residential dwelling are, the minister must be satisfied that determining the requirements will assist in achieving the objective of genuinely adding to the supply of residential dwellings in Australia. Now, all of these taxes that they're talking about isn't necessarily going to genuinely add to the supply. It might reduce demand, but it's not necessarily going to add to supply. And I have a real concern with the the property spruikers out there that a lot of people are sort of onto and discuss, and there is some enforcement action against them. They've just been handed, on a silver platter, because new residential dwellings are exempt from the indexation. They'll be eligible for the discount, all those sorts of things. So anyway, I know I'm ranting there, but it's just
No,
frustrating when you look at the basic
yeah.
economics here of supply and demand haven't actually been addressed.
Well, because as I said earlier, I don't actually think that Jim Chalmers or anybody in Treasury or anybody in the government actually understands the whole concept of supply and demand. I studied it at uni. I don't remember ever reading the chapter where supply and demand is actively affected by taxation policy.
Mm.
But I must have been sick that day that
Yeah,
they
you were
took
sick that day, Darin.
that class. I must
Yeah,
have been wagging class that day because I
yeah,
don't I don't remember hearing my lecturers say that. But with all of what you just said, it actually makes this LRBA thing quite farcical because on the one hand they've said that we're banning it for obviously use of purchasing a residential property inside an SMSF, right? And one of the reasons that the Greens gave for that was to try and prevent property spruikers
yeah.
activity, right? So it's like, okay, so
But then
a,
so you don't want that in an
a
SMSF, but
loan
that's okay
instrument.
outside an
Yeah.
SMSF,
So
maybe.
a loan instrument you think is the root of all evil. And then Anthony Albanese, in his own statement, because I wrote this up when it happened, said that, LRBAs only make up 1%, 1%
Percent of total super.
activity inside the SMSF environment. Only 1% of those funds are using an LRBA. So my next question would be,
Then
well,
why
if it's
bother?
1%, how is that going to shift how is that
The
going to shift
needle. It's
the
not going to
needle?
shift the
You
needle at all.
can't.
Yeah.
You can't argue
Yeah.
with like simple mathematics would tell you if you're making a change to 1%, that is not going to shift the needle at
No.
all. And then how does that, fit in with their supposed mantra of, oh, everything we do has got to, it's got to
Genuinely adding to the supply of
yes,
residential dwellings in
yes.
Australia.
So if so, obviously there's people, again, I say this facetiously, there's people smarter than me in Canberra because they've got me beat because I can't get my head around any of this stuff, right? And
Yeah.
maybe they've got an ultimate plan that I can't see, and they've got me covered because I can't figure it out. I'm sorry.
So yeah, so back again, I'm bringing us back. So yeah, the negative gearing element is a real shame because a lot of people and then I'm back again to the frustrations about this. So the intention here is to increase supply so that young people can buy their first home because it's really hard to get them into the market. And I saw this week the median house prices came out. I think they had gone down in Melbourne, but had gone up pretty much in all the other capital cities, where it's mostly north of $1 million. So that's a lot of money if you're a young person trying to, I mean, it's a median house price, so obviously falls on either side. So, but the consideration with this is if you're young professional, you've got your first job, you've got a partner, and you're like, right, let's save to buy a house. We're on good salaries, we can do this. So then you save money and you put it in an investment to earn some interest or something along the way, so that in 5 years' time, that asset has grown in value, and then you've got your home deposit. To your point earlier, you can't just sell a property like that and have your proceeds, um, you know, 5 days later. Likewise, buying a property, you need a deposit, you need to get your financing sorted, all of those things. So it's a long game that you've got to play. But a lot of people, if you're making the call to play that long game, is that you're building up your assets and you are probably investing them. And so if in 5 years you've built up your little, not nest egg, but your deposit amount, and then you sell those shares or whatever it is, you're going to be paying a nasty tax rate that's going to reduce down what is available for your deposit. So you're actually disadvantaging those
Yeah.
people from that perspective, which is also, a frustrating element there. And the other thing is that so you've got, a young couple who are deciding to, they're going to ferret away all of this money to then buy something. Okay, well, where are they living now? Are they living at home with their parents, the poor parents, or are they renting? Who are they renting from? So they don't own that property. They've got to rent from some slumlord out there who has built up these properties. So you can't, it's addressing one element and not addressing them all. And finally, before we move back onto topic, in WA, in our state budget that came out, there was once again an incentive for first homeowners to increase supply. It's like, no, 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 no. That doesn't increase supply, people. That's just going to increase demand and have those prices go up again. It was, here's back to first homeowners grants. Very similar concept. Oh, that will help with supply. No, 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 no. It'll just increase demand and make it look worse. So again, I feel like, maybe those economics 101 might need to be revisited, but I'm frustrated on behalf of pretty much everyone because all of these provisions are going to make it more work for all of us to have to calculate, not achieve the intended outcomes. The capital gains tax minimum of 30%, that's not going to that's not going to impact the big wigs at the top. The big wigs at the top are paying 47. It's going to impact the middle ground where people might have a share portfolio or one or two investment properties that they've built up over time, and then they sell it and they've got to pay a minimum 30% tax on that when their marginal rate might be, you know, they're just over 45 grand or something. So
Yeah.
it's going to impact that band. It's not going to impact the people at the top level. So
Mhm.
it's been completely targeted it's targeting the top to get the slumlords out of there, but it will actually more adversely impact that middle band and the lower band because
Well,
they can't get that tick up.
it might be targeting the top, but if they're aiming at them, they've missed badly, I'm afraid.
Really missed. Yep.
Um, well wide of the mark. And, to your point, again, I made this point off air that if you're looking at CGT, the big whack now, there's no understanding of actually how younger people operate. I mean, I'm
Yeah.
having to get my head around this as well because this is starting to significantly encroach on the SMSF area. But
Yeah.
more and more young people, which assets do they like? They like crypto, right? They
They like
like
the quirky stuff. Yeah.
yeah, that's right. Which will give them, potentially, depending on where they are in the cycle, a significant capital gain at some point in time. And crypto, as we know, really, basically, it's 99.9% a capital play.
That's right.
It's not a play for income, right? So this is the I'm receiving a huge boost, Gemma. I've made heaps of money on my crypto now. I've sold it yesterday, and I can look to buy my first home, which is sound. No one can criticize that. But now, all of a sudden, oh, Gemma, I got rid of my crypto, but I lost half of it
Yeah.
because it's a capital gain.
Because I've got, but
Um,
what's going to also happen there is that you sell your crypto and let's say it's gone up. You invested 10 grand and you got 100 grand. I don't know, I'm making numbers up, right? So you got 100 grand in your hot little hands in your bank account to put down your deposit. When are you paying the tax on that? You don't pay it until you lodge your return for that year. So we're chatting right now in July 2026. So obviously these new rules don't apply yet, but let's say it was July of a year that these assets were sold. You get your 100 grand, then the timing of when that tax return is due, you've got to wait till the end of that financial year. So that would be, in our current scenario, it's 26, 27. Then you've got till May if you use a tax agent. And then all of a sudden, Jimmy's got a tax liability of 40 grand that hasn't been budgeted for by him or, you know, whoever is. And then where are they going to get that money from?
yeah,
So it's going to be a really, that's where the bank of mum and dad is going to have to come through
yeah,
then. But
yeah.
but not everyone has that privilege or that luxury. So
No,
but that flow on effect, so all of these things have again made super more beneficial. And also for a lot of people who are in that SMSF world, maybe they do have the ability to help their kids out and
yeah,
get them that step up.
yeah,
But the other thing is that they want to increase supply. And that might be people selling their assets and things like that. But that's actually going to bring some pricing down, again, economics. And so the poor buggers who invested in the last few years and pushed themselves, the equity that they might have in their houses might be negative
yeah,
because of these all things happening. But what's the
yeah.
solution? I mean, I'm throwing in like all these problems and issues with this, and I don't like it. But I don't know what the solution is
Well,
because well it's increasing, so it's proper increasing
yeah.
supply. And yeah, we
I
did
mean,
have a solution earlier, didn't we, Darin? Removing
that's
red
got to
tape.
yeah, that's right. That's got to be the solution is increasing supply, but they don't seem to understand that because all,
No.
all the government wants to do is raise revenue, right? So that's basically it. I mean, they
Yeah.
can dress it any way they like, but that's the ultimate goal. And we all know
Yeah.
that. So it's even more
It's trying to
insulting.
put lipstick on a pig, basically.
That's right. So
Yeah.
so so anybody listening to this can obviously feel our frustration with this.
Frustration. So
I think the
frustrated.
thing that frustrates me the most is, look, the Treasurer and the Prime Minister and people who work in Treasury might be that stupid, but we're not, okay? So don't insult our intelligence. Just tell us the truth that you're idiots, and I'll respect you more for that, but don't insult our intelligence. Anyway, I'm going to bring it back to the
We're going to
superannuation
need to bring it back
because
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 I'm
we
conscious
had
of
a
time.
we had a win, and one of the reasons why we're doing this is the whole trust tax
Trust side of things. That's exactly
thing,
right.
right? So they
Yeah.
they introduce a new tax, a 30% tax at trust
At the
level,
withholding
and what?
tax at the trust
Yeah,
level, which
sorry,
is
yeah,
not a
yeah.
win. That's not a win, but there was an
No,
element of that original
that's not,
announcement
and
that has
it's
been a
for
win. Yeah.
discretionary trust, right?
Yeah.
So
Yeah.
everybody, once the initial announcement was made, everybody was worried that it would, and on the surface of the original announcement, yes, it would apply to testamentary trusts, which of
That's
course
right.
are a huge, um, well, a lot of people use them, but in
Family
particular, a
planning.
lot of
It's yeah,
people use it for estate planning, and that's a legitimate estate planning tool for a variety of reasons. I mean, we can
yep,
go back. We have mentioned before that case of where you got to protect individuals from themselves, and we had
yep,
that case. Not that this is a testamentary trust, but potentially a bad scenario where the son drug addict, yeah, stripped out the SMSF of all its
yep.
assets to fund his drug addiction, and then the parents were left with the shell of the fund with no assets in it, but still accountable for what
But
happened.
and all the penalties. That's exactly
Yeah.
right.
Now
Yeah.
that's not anything to do with a testamentary trust, but a testamentary trust, especially with estate planning, is to guard from those situations where
Yeah.
you think, actually, you know what, Gemma's not really good with money. When I
Gemma's
guard,
not financially literate.
I,
I
I,
like to
I,
use the
I want
terminology.
to obviously leave her some money, but I'm just afraid that if it just comes in a lump sum, she's just gonna, fritter it
Take it to
away.
the CAS and put it on
Yeah,
red. Yeah, those sorts of things.
needlessly. She's gonna go to, is it Burswood in
Yeah.
WA? So she's going to go to Burswood, which is
Crown.
now
We have a crown,
Crown.
but it's in
It's now
Burswood. Yeah.
Crown.
Yeah.
And she's going to put it on red on the roulette
Yeah.
wheel. And I don't feel comfortable with that. So
Yeah.
I'm going to set up a structure that will protect her from herself
Yep.
because, you know, she's just got a bit of a weakness that I want to save her from having it
She has a
penalized.
penchant for nice jewelry or designer handbags or something,
That's right.
but not
Something
really
like
for
that.
funding a proper lifestyle. So before we talk about that bit, I'm just going to take a step back and talk about how on budget night, the announcement was that discretionary trusts, so not fixed trusts, discretionary trusts would be subject to a 30% minimum withholding that was non-refundable. So that meant that if the trust generated $100 of profit, taxable income for the year, it would withhold a 30% tax on that. And, in distributing that out to individuals, then there was 30% tax that had already been paid. So it kind of operates a little bit like franking credits. However, franking credits are refundable, and this is non-refundable. So what would happen is if I got distributed that $100 and that was my only income for the year, and so I paid no tax, my effective tax rate was zero, there's a 30% that had been withheld, and I can't apply for a refund for that.
Yeah.
So that was the bigger announcement. Again, for those people who are in highest marginal, if you're not hitting the top end, you're hitting the middle band of people who run their businesses through a discretionary trust, and or they have a discretionary trust there that might have $1 million in it, generating some income, but a 30% minimum tax is pretty rough if you're trying to run from that perspective. The other thing, and this is probably more telling in terms of the policy, was that if you distributed from a discretionary trust to a company, that tax offset was not available. So what would happen is, so say that go back to me, $100 gets distributed to me, but if I'm on the highest marginal tax rate, I pay $47 on the 100, but I get a $30 offset because the trust has already paid that on my behalf. If I'm a company and the trust has withheld that $30 in tax and that $100 goes to the company will pay its $30 in tax on it if it's a passive company, which is what I'm really talking about here, but gets no offset for the tax that the trust has paid. So it's paying 60% tax effectively on that. Now, it'll add to its franking account there. And then if you distribute that, declare a dividend out and all that sort of stuff subsequently, then there will be a franking credit there. But I think ultimately we've run the numbers and it's about a 72% tax rate if you go
Wow.
from the trust to the company and then the company flows that out because of the
Yeah.
way that is a non-refundable in a company scenario. So really they want to clamp down on companies. Now, originally what the announcement was that it wouldn't apply to existing testamentary trusts at the date of the budget. Now, that didn't mean a trust that was drafted into a will that was done, but the person hasn't died yet. That means a trust that was in place at that time because someone had died. Now, if you had estates that were in the process of administration and that trust sort of really technically is set up on death but hadn't really kicked off yet, would that be caught, et cetera, et cetera? So ultimately, and this is where the win is. So a lot of concern here, obviously, about testamentary trusts. What are they for? Who are they to benefit? And why should they be subject to this? Because often it's little kids that are getting distributions from trusts. And testamentary trusts have got that tax benefit because you can flow money out to minor beneficiaries at adult tax rates. But always, in my opinion, of higher benefit was the asset protection that they afforded themselves if structured correctly. So that was still a benefit there. Then subsequently, again, with a lot of backlash and advocacy, what has been announced is that testamentary trusts, any testamentary trust, will be exempt from the 30% withholding. So that has brought to the fore a lot more structuring opportunity because if you're not looking at an inter vivos trust being worthwhile, do you go down the path of, look, we'll just use a company. We use a company where the shares are owned by mum and dad, and that generates a profit. We can distribute that out. We can still get our refund of franking credits, et cetera, et cetera. But overarching all of this is we can't let the tax tail wag the dog too much because it's all
Mm.
well and good to build up assets in a company that are owned by mum and dad. But if mum and dad get sued because they're high risk individuals, then you'd rather have, say, 70% of money than 0% or than 100% of zero because asset protection and they get sued and PI and all that sort of stuff. So excellent outcome, but we still need to be aware of how that asset protection element factors into it all as well.
Well, it's another classic case of not understanding, I don't think, how trusts work and what they
Yep.
are used for from certain elements in Canberra, because
Mm.
all they see is that a trust is a way of getting around paying more
Paying
tax,
income tax.
right?
That's right. Yep.
So now setting up a testamentary trust may have absolutely nothing to do with that. We've already gone through the scenario
Yep.
of, a drug addicted
The
child or
spend or the
something,
spendthrift.
something
Yep.
like that. Yeah, or the spendthrift
Or
as
the
well as the
vulnerable
asset.
person that just gets taken for a ride every time.
Yeah. And the asset protection element is huge. A lot of
Huge.
people do that for the protection element. So not understanding that is to me ridiculous, but lays bare again the you talked about financial literacy. I think lack of financial literacy in Canberra. Now there is one catch though, Gemma, and I suppose we've only got to wait to see how this actually plays out. Um, in the amendment, I believe testamentary trusts have been carved out, but the
Yes.
testamentary trust has to be, and I think I quote here, for genuine testamentary purposes.
Oh, well, and what does that mean?
So, well, there you go. You've just answered
Well,
the question.
also the thing
So,
with
what
that
is the
is,
what's the definition of that?
yeah,
They haven't,
well,
and they haven't provided that yet. Okay.
and I think that that's the challenge with these trust changes is that so the capital gains tax changes, they kind of needed to be bulldozed through Parliament because with a 1 July 2027 start date, people need time to plan. The trust changes aren't expected. Well, the proposed start date for those is 1 July 2028. So we've got more time. So it's really a bit of not legislation by announcement, but all we've got to rely on is announcements. And it's always the devil in the detail on those particular elements there as well. So, 1 July 28, they've also announced in the budget that people will have the ability to get rollover relief if they decide to restructure, which is fine if I mean there's already a whole bunch of rollover relief in there for small business restructures, etc. So I'm talking in the situation that a small business might be run through a discretionary trust and mum and dad are both involved in that, and then all of a sudden that's pretty tax ineffective. So if they roll over their business to a company that they might wholly own or between the two of them, CGT rollover relief. So that's all well and good, but they've sort of said, oh, rollover relief, how great. But what about stamp duty? So in WA, the goodwill on a business, if you there is some rollover relief available, but that's subject to stamp duty. And which every jurisdiction is different. So again, complexity, not targeting the people that it is proposing to target really, and it's done with a tax lens, and unfortunately, there's a wider lens that needs to be looked at
It's
here,
a
like asset protection and succession and stamp duty, other sorts of things like that.
It's not only done through a tax lens, Gemma, it's a very narrow tax
Narrow.
lens as well. It's not even like, because obviously stamp duty is a great point, but they don't take that into consideration because that's a state tax.
It's a state tax, and every
So
state's different.
I could turn around and say to you, well, why would I care about that, Gemma? I don't have any control over that. Every single state is different, so I can't take that into account. So
Yeah. So, meh.
your way, tough luck.
Tough luck, exactly.
Yeah.
So anyway, again, we wait and see what that all looks like in terms of rollover relief, like you said, for genuine testamentary purposes. So testamentary trusts had a bit of an integrity measure imposed upon them, I don't know, five, or if not longer, probably 10 years ago. Because let's say, Homer dies and Marge gets everything. So, that's how it works. But it could be, right, well, in his will, he sets up a testamentary trust for each of Bart, Lisa, and Maggie with $100 in it. So then each of them can pick up that trust. They've got a testamentary trust. They could then lend into that trust $1 million and then go off and invest that and then use their kids' tax rates for the distribution of that income.
Yeah.
So I mean, that does sound like you're sort of taking the mickey a little bit. And not many people would actually do that. They'd be like, right, I'm setting up a testamentary trust, all of the assets of the estate divided by three in that particular scenario. But there could be an opportunity there for people to just say, okay, Homer's on his deathbed. Let's just get him to do a codicil to his will and give Jemma a testamentary trust with $100 in it, and then Jemma can go off and do all of these things. So what they changed is they put an integrity measure in place within the testamentary trust provision. So this is of the 1936 Act, Section 102 AG, about accepted trust income is the concept. And you could only get accepted trust income if it was on the original testamentary gift. So you couldn't add fresh loan monies to that trust.
Yeah.
And if you did, it would taint that accepted trust income element of it.
Yeah. Yeah.
So there was already an integrity measure sort of sitting in there. It's a bit like, death, like Division 296. There's already a massive integrity measure in the super legislation, which says when the person dies, the money has to come out.
Yeah.
So just wait for, anyway, calm down, Gemma.
Compulsory
Calm
cashing
down.
event,
Yeah. So
you know.
so we have to wait and see what that looks like. With the CGT side of things, I'm just conscious of time because we're pretty much at where we should be. With the CGT side of things, this year is going to be another year of, if we're looking at Div 296 for clients, it's going to be looking at CGT. Do they sell an asset? What does it look like if they wait? Again, making some sort of prediction about how much it might be worth in 1, 2, 5, 10, however many years' time. You've also got to overlay some of these things with, we've got some clients that receive incentives through their work that are employee share scheme. And so, again, how that interacts with these provisions as well, because they might not have vested yet, but then how does that all flow through? One of the things that I guess is good as an outcome is previously, if you had realized capital losses that you had carried forward, and then you look to offset them against a gain, you sort of lost half of the loss. So at least you can fully use your losses sort of going forward because you're going to have a full gain that might just have that discount element attached to it. So yeah, I feel like there's going to be a lot of work that the industry is going to have to do between now and 30 June 2027. The lead up to 30 June 2027 is probably going to be pretty foul because you'll have those last minute people looking at, oh, for Division 296, I've got to pull out all this money because it's, this is the transitional year of it's the and we will record another podcast about where Div 296 has finally landed. Um, I've got to pull all this money out so I'm not subject to the greater of the opening and closing because this is a
Yeah.
transitional year. So again, all this work is going to have to happen, which is just another like just put it on the back of the industry to be managing. And it's no wonder that a lot of accountants I chat to, the strikes are there, two more strikes and they're out of all the extra bits and pieces that come through. So anyway, on that note, I'm gonna perhaps we finish up there, Darin.
Well, yeah, I think we should finish up there. We could probably go on for hours actually about
Hours.
this stuff. There's so much stuff to unpack and obviously peripheral stuff that we didn't even talk about really
Yeah,
that it's not directly budget related, but it all plays into the same thing. But the bottom line is we've had a few wins with the superannuation
we
area,
have. Yep,
which is great. We
totally.
should celebrate that. Still a few bits and pieces to be determined, but it's like with your football club, a win's a win. So you just
Yeah,
take it.
you take it. That's right.
So on that note, we're going to take that win and we're going to conclude this podcast. So I'd just like to thank you, Gemma, for joining me in pretty much having a bit of a rant today, but
Bit
as
of a rant.
as
Sorry,
well
everyone.
as
Bit
mixing it
more
in with
ranty than
some
usual.
technical stuff as well. That's okay. Still hopefully informative. So thanks, Gemma, for joining me to do that.
Thanks for having
Um,
me.
thank Thank you also to SMSF Property Valuations for their continued support. And as we said right at the start, valuations are going to be huge, particularly in the next 12 months. And thanks to all my staff, obviously, for putting these podcasts together and making sure they're published on all of our media channels. So, other than that, most importantly, I'd like to thank all of you for joining us and listening in to this podcast. And until next time, travel safely and have a great day.
Thanks, everyone.